Hey everyone, it's Julie here with TipRanks. Today, we're taking a look at 3 trending tech stocks that have been dipping in price recently. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today, we're taking a look at 3 tech stocks that have been trading in the red recently, but are trending with Wall Street analysts over the last few days. Now, we have seen a sell-off in the tech sector to start out November as there's been growing concerns over stretched valuations. But despite this, we've seen a lot of Wall Street analysts recently reiterate buy ratings on these stocks. So we're going to take a look and see why they think this is a buy the dip opportunity. I found today's stocks over on TipRanks Trending Stocks page. That is found right under the Tools menu, and here you'll find a collection of stocks that have been gaining all of that Wall Street attention. I narrowed in on the best rated stocks in the last 72 hours, focusing on the tech sector to get our list of companies down below. You can check out these trending stocks for yourself on the TipRanks website or on the TipRanks mobile app, which you can download using links in the description below. If you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel. Now let's dive right into our 3 trending tech stocks. First up, we're taking a look at AvePoint. They trade under the ticker AVPT, currently priced at $12.20. Overall, in the past year, they've fallen 23%, and in the last 3 months are down 18% and saw a big drop last week. AvePoint provides Microsoft 365 data management solutions worldwide, offering a software-as-a-service platform, cloud-hosted collaboration systems by providing a suite of software products. They focus on data protection, governance, compliance management extensions for Microsoft 365, Dynamics, Salesforce, and Google Workspace. They did come out with an earnings and revenue beat last week for their third quarter. However, the ongoing government shutdown put pressure on the stock. The ongoing shutdown created uncertainty, affecting deal timing and contributing to a conservative approach in maintaining their ARR guidance. Revenue growth in North America was also impacted by relative softness in the public sector, with a noted decline in federal upsell opportunities affecting their gross and net retention rates. However, on the positive side of things, they did deliver quarterly records for net new ARR, the number of 100,000 plus customer adds, operating cash flow generation, and non-GAAP operating income. Revenue climbed to $109.7 million, which is up 24% year over year. Over the last few days, we have seen quite a few of Wall Street analysts weighing in while reiterating buy ratings, but many of them were also slightly lowering their price targets. That included an analyst from Scotiabank who noted that there were pluses and minuses to the quarter, with ARR only in line with consensus and no guidance raised paired with that ARR growth. With shares down 20% over the past 3 months, the firm believes that shares look attractive. We also heard from an analyst at Cantor Fitzgerald, who said that AvePoint is well positioned to benefit from increased focus on data unification, governance, and security trends, including related management of data governance and access related to Microsoft Copilot rolls out longer term. Their stock currently has 12 analyst ratings, coming in as a strong buy with 10 buy ratings and 2 holds. And the average price target of $19 implies an upside potential of 58%. Looking at those price targets down below, you will see several analysts dropping their price targets a couple dollars, but those upside potentials still range from 31% all the way to 113% upside. For our second stock, we're taking a look at FIVN. They trade under the ticker FIVN, currently priced just above $20 per share. Their stock has lost 50% over this past year, and in the last 3 months is down 17.5%. FIVN provides cloud software for contact centers in the United States and internationally. They offer a virtual contact center cloud platform that delivers a suite of applications, enabling the breadth of contact center-related customer service, sales, and marketing functions. Its solution enables its clients to manage these customer interactions across various channels, including voice, video, email, website, click-to-call, and more. They did come out with an earnings and revenue beat for their Q3 last week, but they did see a decline in their commercial revenue. And a declining revenue growth rate has been a theme this past year that's been weighing on the stock. Their commercial revenue did decline in the teens year over year, attributed to underallocated demand gen spend and a gap in sales capacity. Their revenue growth was also negatively impacted by approximately 5 percentage points due to a tough compare from a large customer and minimal seasonal uptick. On the plus side, their enterprise AI bookings grew more than 80% year over year, and their subscription revenue did grow 10% year over year. Overall revenue came in at $285.8 million, up 8% year over year. And this is another stock that, while we are seeing analysts lower price targets, many of them are still reiterating buy ratings, including a 5-star analyst from Roth Capital that just weighed in on Friday. They said that while sentiment will remain challenged by weak guidance, Five9's already severely weakened valuation leaves the firm constructive, as does its improving bookings, AI revenue strength, and a new $150 million share buyback authorization. They reiterated their buy rating and said they would add aggressively on weakness. We also heard from an analyst at Barclays who said that while the company is posting lower growth, the stock's valuation levels are getting very low. The Five9 stock has attracted 19 current analyst ratings and comes in as a moderate buy with 14 buys and 5 holds. The average price target of $34 implies an upside potential of nearly 66%. Looking at those price targets down below, they range from an upside of 16.5% all the way up to several at 94%. If you've made it all the way to our third stock today, then do me a favor and make sure you've hit that thumbs up button. Third on our list, we're taking a look at Block. They trade under the ticker XYZ, currently priced at $65 per share. Their stock has fallen 21.5% over the past year and is down 10% in these last 3 months. Block is a fintech company that specializes in providing innovative payment solutions, best known for their apps Square and Cash App. They operate primarily in the digital payment and blockchain sectors, offering a diverse range of products including mobile payment applications, point-of-sale systems, and cryptocurrency management tools. They aim to simplify transactions and enhance financial accessibility through their user-friendly platforms. Their stock fell after both earnings and revenue fell short of expectations for their third quarter, and they saw an increase in expenses. Earnings per share of 54 cents fell 10 cents short of expectations, and they've had a few quarters now where earnings have missed. Revenue came in at $6.11 billion, which only grew 2% year over year and missed by $200 million. There were concerns about the macroeconomic environment and potential impacts on consumer spending, and a decision to increase operational flexibility at a processing partner increased costs. On the positive side, their Cash App gross profit grew 24% year over year, and Square's gross profit grew 9% year over year. They've also launched different AI tools like Square AI and new different product features. Once again, Wall Street looks cautiously optimistic as we have analysts lowering price targets but still reiterating buy ratings, including one from Goldman Sachs. They noted the post-earnings sell-off amid stretched positioning and cautious fintech sentiment. Despite near-term volatility, the company's accelerating top-line momentum and expanding profitability position it as one of the stronger growth stories heading into 2026. The Square stock has 28 current analyst ratings and does come in as a moderate buy with 22 buys, 3 holds, and 3 sells. So a few more mixed opinions here, but the average price target of over $85 does imply an upside of 32%. Looking at those price targets down below, we have a bit more of a range here between our sells and buys. We do have a sell rating with a downside of 15%, and on the high end, several buy ratings with an upside of over 61%. So that is a quick look at 3 trending tech stocks that all have been dipping in price, but analysts seem optimistic for a recovery on. Let me know your thoughts on these tech stocks and which of them catches your eye. I always appreciate hearing from you guys. Please keep in mind these videos are never a suggestion to buy or sell any specific stock, so please make sure you always do your own research and due diligence. Thank you so much for watching. Have a fantastic day. I'll see you back here next time.